Okay, well let's take a quick look at the cotton markets. We had our ups and downs, and lately we've had mostly downs, both in the old crop, which is the blue line there, the July contract, and the new crop, the December contract. They both slipped through the 70s and are trading in the lower 70s, 72 or thereabouts. Um, some of the reason for that is explained here by the peaks and valleys of the green shaded area. That's the hedge fund buying and selling. You can see a great big buildup of green here. That was a whole bunch of speculative buying that is what took the market up. The market plunged on speculative selling. This is back a few months ago, went in a sideways pattern for a while, had some smaller ups and downs of spec buying and selling. But if you look at the far right here, there's a downward dip in the green. That's a net short position, meaning that there are outright short, that is outright sellers who sold the market and are waiting to make a profit on buying it back at a lower price. And so they're sort of in a
She
self-fulfilling
died.
prophecy
I said
sort
there
of
was bigger
way.
than 6 more inches. I knew it. That's
They
yeah.
are contributing to this downfall. And so whatever bearish news is
Yes,
on
she
their minds, they're acting on it, trying to make a profit.
It was bigger head up
The
6 more inches.
fundamentals for both the old crop, which is the 23-24, the middle column of numbers, and the new crop is the right-hand side column of numbers. I've got the bottom line ending stocks variables in both of those years circled in red down here at the bottom. This is 2.85 million bales of ending stocks left over from the 23 crop, that's pretty tight. I'd say prices are lower than they should be given that level of tightness. But what's projected for the new crop, for the 24 crop, which is, just getting planted or if growing up in South Texas, here we're looking at over 4 million uh, bales of ending stocks, which is an increase year over year, and that would normally be interpreted as a reason for 24 prices to be somewhat lower, modestly lower than 23 prices, because we have a modest increase in ending stocks of 1.3 million bales or so. So that's what the fundamentals tell us. Now there's always a lot of moving parts of supply and demand that get us to the ending stocks number. So let me talk about some of those really quickly. We've got a guesstimate out there, USDA does for the time being, that we're going to plant a little under 11 million acres in the 10.7 specifically, and that was based on their survey in March. They are taking another survey right now as we speak, that they're going to report at the end of June. So we'll have another snapshot of what the acres is. What this chart shows is sort of how much the March estimate can change to the final June estimate. And it can change as much as historically it's been as close as 1% or as distant as 17% difference. That is, the planted acres numbers that they measure in March can be different from the final outcome um, because crop prices can change, because um, people don't get to plant what they intended to plant because of wetness in the delta or dryness in the high plains. We've had some crazy weather. It's been very, very wet in the northern, well, in Louisiana too. So all over the mid South. So probably some intended cotton didn't go in. If you're up in the high plains, I seems like they go from having a rain to being over 100 degrees to having 60-mile-an-hour winds. It's not one thing, it's another. I can't imagine what that does to growing stands of freshly planted cotton, but we'll see. Anyway, long and the short of it is we'll see, and maybe we'll have more than 1 million acres. We'll just have to see. But just given the 10.7 assumption that USDA is holding to so far, I'll go back to this column here. They're guesstimating 10.7 in average abandonment. That means they're going to harvest 9.13 million. It's like 12 to 15% abandonment, which I would expect for this kind of year. They're coming up with a 16 million bale crop. Even without increasing the acres, they're coming up with a 16 million bale crop. And that's sort of based on how the weather's been and how the moisture has been. Um, so let's look at some of that. Dr. Welch may repeat this and explain it better than I do, but right now we have slipped from the El Nino, the wetter than normal condition. We have slipped into um, the neutral situation, which means that the equatorial waters in the Pacific are basically where they should be. They're normal, and so the El Nino forecast has ended, and we're in just a neutral situation. But we're forecasted to slip into a La Nina, which is drier than normal, particularly in the wintertime. During the summertime, the effect of a La Nina condition is, well, basically neutral. It's no different than a normal hot, dry summer. So, I have heard forecasts that, well, no, the La Nina will contribute more to Atlantic tropical storms. Okay, I, I'm not a weatherman. I'll take their word for it. But these historical maps of weather influences of La Nina in the summertime don't really show much of an effect in the summertime. So I'm just going forward with the assumption we're going to have a normal Texas hot, dry summer. And I'm going to guess with USDA that we're probably going to produce 16 million bales. And, I'm going to base that partly on what we're looking at here. Texas is, the eastern part of Texas is very well watered. And I'd say that the rolling plains and the central plains regions over here are reasonably well watered, especially compared to the previous couple of years. And the high plains is, got some yellow, but I mean, the high plains always seems to have something. It's turning off drier in the southern portions of the state, particularly the down here in the Winter Garden region. And here in the coastal bend, or down in the coastal bend where I'm headed later today, we're at the stage of where they're harvesting sorghum, and probably what's done is done. I'm going to guess with the cotton crop. I don't know if it would benefit from another good soaking or not. It's probably going to get one from this tropical thing that's floating up to us. So again, we'll just have to see, but I don't see anything in the weather map. I don't see anything in the drought map that would contradict the assumption that, yeah, we can probably grow a 16 million bale crop. There's just the weather forecast. So if we do grow 16 million bales, which is a bigger crop than we've seen in a couple of years, will demand balance it out? And I don't know that the demand outlook it's certainly not rosy. This dotted green line is just the forecast of world economic growth. This is percent over here. And they're basically forecasting flat, slow growth. That's what that means, which that's not going to balance out a big increase in crops. So, and then, there was some hope that the Federal Reserve is going to maybe get around to cutting interest rates after raising them all this time to tame inflation. Inflation's the blue line there, and these plus red numbers are when they raised the interest rate figures, but they've stopped raising them, and I don't know that they'll get around to cutting them this year. There's some speculation that they might later in the year, but that seems to be pushed back every time there's another report that comes out. So, till something clear happens, I'm going to look at this as a headwind. So it's not particularly encouraging for demand. So the summary of the outlook is we're going to have modestly more production, and it may not be balanced with an increase in demand. So we can see the very increase in ending stocks that USDA is projecting. I think that's very reasonable. We may have 4 million plus bales, which is a modest increase year over year, which would explain some of the price pressure that we're seeing this year with December 24 futures, which is this red line um, measured on the scale over here in cents per pound. We've sort of already had our second quarter plunge, which happens seasonally. You can see what the blue line is, a seasonal index that shows on average how the December contracts will move across the final months. And they typically have a second quarter peak, and then they plunge, and then harvest time weakness. It looks like we've already kind of taken that dip. There may still be some bouncing around here because the crop isn't finished, and there will be uncertainty, and there will be um, things that happen that'll cause some panic buying or some speculative buying. So I expect us to kind of bounce around here, but eventually I think we're going to wind up kind of where we are, even lower. I think the possibility is there for us to slip under 70 cents by harvest time. So not a particularly enthusiastic or encouraging outlook, but I'll take any questions that anybody has when the time comes. And till then, I'm going to hand it off.
Hey, do you all have any questions for John? John, I have just one quick question. We're looking about all the variables, bearish variables affecting the market. It looks like you have everything in there. What else are we missing that might decrease prices a little more, as you were talking about?
Yeah, I in the interest of time, I left off my black swan what if slide. But if we elect a second Trump administration, the last time we had a Trump administration, they slapped tariffs on China and talked tough to Mexico and things like that. If any of that comes about from a second Trump administration that disrupts trade, last time it kind of caused the collapse of the soybean market and the cotton market. That's sort of a black swan event that would be extra negative. That's not penciled into what I was talking about so far.
Okay.
And then, the Ukraine war is still going on, and China is saber rattling about Taiwan. I hope that doesn't lead to anything either, because that would tank markets worldwide if it happened.
Excellent, John. Thank you very much. I appreciate it.
Thank you.
Mark, do you want to start with your presentation?
All right. Very
Thank
good,
you.
Pancho. And let me know if there's an issue with the sound or the pictures. Appreciate the opportunity to share again. And I'm going to follow a lot of the same things that are themes that Dr. Robinson was sharing in his cotton outlook. You're going to see some of that, the same concerns as we talk about what's going on in our grains. I want to start on wheat. That's the one that's had the grain market that's probably had the most dynamic price movement over the last couple of months. A couple of different price patterns here. The blue line is the closing price of the July Kansas City wheat contract. This goes back to August the 1st when we were selling $8 wheat on that contract. We were along that long slide down into February and March, when typically, according to the seasonal patterns of that contract, which are indicated by the red line, this is what you'd expect on an average kind of year. You get kind of a price rally in February and March, then a kind of a mid-winter dip, then perhaps another late season rally coming in late April and early May before we fall off prices at harvest. Well, we never really got our February-March rally, but when we got this April and May price movement, it was pretty strong. We went from about $5.50 on the board, ran that up almost to $7.50 for the highest trading point, didn't quite close that high, and now we've fallen off pretty hard as we're heading into harvest, which again is right back with our typical seasonal pattern. But whether we kind of end up down here or not, the jury is still out on where this contract is going to close, and the price implications that drove that price higher are still unfolding as we go through this late spring and get into the early summer fundamental information on the wheat market. And so I've kind of driven this box here, and I want to focus on what was happening in the world wheat market, particularly on the supply side, that perhaps fueled that kind of rally and may give us some information of whether this is a dip or whether this and will bounce back up, or whether that price is kind of done. We'll start, first of all, looking at growing conditions in Garden City, Kansas. That's kind of the heart of the hard red winter fruit production area here in the U.S. You can see where Garden City is located in that map, and kind of the western side of Kansas, of course, being the #1 hard red winter producing state. And this is a chart of precipitation, which is in the red line, measured precipitation in 2024 compared to the long-term average, which would be the gray lines, have precipitation on the top and minimum temperatures on the bottom. And since the 1st of January, we had a long dry spell there in western Kansas. Very little added moisture as we went through January all the way up into the toward the end of April. So we were dry and getting drier as the crop is breaking dormancy, trying to wake up and get going after into the spring. And then if you look what happened to temperatures, that we had some temperatures falling below freezing. That would be the 0 line. So we're dry. We had some temperatures below below freezing, which would certainly impact the reproductive stages of wheat. Is very vulnerable to freezing temperatures this late in the year. We're talking about past midpoint of April, and so worrying about the damage that was causing to that western Kansas wheat crop, and then to U.S. wheat potential. So that's what was going on in western Kansas. And again, this green box is when we've seen the prices really starting to take off, and then now they've started to come down here as we've gotten into late May. So that's what was happening in Kansas. The other area of primary concern was in southern Russia. This is that area of Russia that kind of extends down here between the Black Sea and the Caspian Sea. This little neck of land is where primary winter wheat production occurs in Russia. And the darker the area, the more concentrated areas of production. And so what I've done is I've just kind of at random chosen a weather reporting station that's kind of right in this narrow neck of land in that concentrated area of winter wheat production. And we're going to look at the same factors, precipitation and temperatures. And you can see much the same pattern, a little bit above normal precipitation early in 2024, but then a long stretch of no additional precipitation. And then day two, as we got into late April, that the temperatures dropping below freezing. Now they had a rapid warm up. It was warmer than normal for several weeks. We're just kind of waking that crop up. We're getting going. And then with this dry conditions, as well as then dropping those temperatures below freezing, are we going to see that same perhaps crop damage potential as we get into the key producing areas of Russia. And so that's kind of what's driven this wheat market like it has. And in terms of the U.S. crop, USDA actually in the June WASDE, the notes here at the bottom, they actually raised the Kansas wheat yield from the May estimate to June. And so that doesn't mean we're not going to have some crop damage out in the western parts of the state, but not enough to pull down the statewide average. In fact, better otherwise, that we took an average of 38 bushels and raised that up to 40. We increased the supply of wheat in the June WASDE that we were anticipating back in May. We did increase some of the use numbers, particularly in exports, a little bit export potential, but we're still expanding supply. And if the weather is anywhere close to normal in 2024, increasing supply more so than we're seeing the increases in use. And that, of course, is a recipe for a negative impact on prices. And that would be the projection we're seeing from USDA currently, and certainly reflected in that harvest time Kansas City wheat contract, as we're seeing July trading down sharply lower as we're moving along through harvest, particularly in the Southern Plains. So again, the harvest prospects are still unfolding. In the U.S., it's looking more positive. Will that same thing hold as we begin harvest in Russia in July and August? And that'll be the next key, the next leg for this market. Look at the corn market and some things that are going on there. The big feature in corn today would be the excellent conditions we're seeing for the early crop condition ratings for 2024. We've just had 2 weeks of reports, but 75% of the U.S. corn crop has been coming in rated as good or excellent, or good and excellent combined. We're at 75%. That creates a really strong crop index. And the index is created by multiplying the excellent by 5, the good by 4, and so forth. And that gives you a comparison of what the index would look like in a normal year, which with this blue dotted line, and the degree to which this year's crop condition index rating is better than average. I'm going to zoom in on that a little bit to show, just compare that index to this year as well as to 2023 crop. So now by zooming in, these are the crop condition index ratings for 2024. If we have normal index ratings this year, that would point to a U.S. corn yield of about 180, 181 bushels per acre. The green line is what our index did last year. We started out with a good number, but then it got dry, it got hot in the Corn Belt, and the index ratings fell sharply as we went in through June. Then started to rebound a little later in the summer, and we ended up with an index below normal and a yield that came in below trend line of about 1%. However, that yield of 177 bushels last year was still an all-time record high. So how we're going to unfold this year is going to be a real question in terms of the price movements and impact. And I've just compared this year's price movement so far. That's the black line. Those are December 24 corn futures. And it's not really an index other than that's the price of the 2014 contract based on an index of the high of the year and the low of the year, which are basically seasonal patterns, except we hit the high of the year in April and May in 2014 rather than late June, which would be the normal time. We fell off strongly in 2014. We took about 3 or 4 weeks measuring those crop condition ratings. And in 2014, we stayed at 75% good and excellent all through the month of June into early July. And in fact, for the rest of the year, the corn condition ratings didn't fall much below 75% good and excellent for the entire year. So that's the season we're in right now, is how strong these ratings are going to hold as we get through that tasseling, silking stage, and then get a weather forecast into August and September to finish this crop up. But typically speaking, yeah, you see a run up early spring, kind of flatten out this time of year, and then we're just right at a real determining point of which way this market's going to break in the next few weeks. If you look at the supply and demand situation for corn, much like for wheat, if we have a decent year, we hit that yield of 181 bushels, even if we plant 4 million acres less, we're still increasing our corn supply year over year. Domestic use up a little bit. That would be a record high this year. Exports rebounding somewhat. So even with total use coming back, again, if the weather conditions cooperate, we're such that supply is still expanding at a faster rate than our consumption or use categories, which again puts that downward pressure on prices. Grain sorghum the same way. Look at the yields. If we have an average yield this year compared to the poor yields we had the last two, that's going to increase our sorghum supply significantly. Even with an increase in use, domestic use is up, exports are up, still not quite keeping up with what's happening on the supply side and downward pressure on prices. So I think that's kind of the feature of the grain markets right now, that with normal weather, factors of supply increasing more so than the factors of demand or our use categories, but it's all weather. We're in the weather market has driven wheat, still will in Russia, and we're still in that price breaking or price moving window of opportunity when it comes to our corn and grain sorghum markets. But again, if the weather cooperates, we're at the point at which those prices are likely to start moving lower as we get to the rest of the summer. So, Pancho, what I'm going to share today. Appreciate you making this possible for us again, and I will turn it back over to you.
Thank you, Mark. I appreciate it. Hey, any questions before David starts his own presentation? David, whenever you want to start.
Hey, are we there, Pancho?
Yes, perfect. Thank you.
All right, great. Well, I guess I need to thank Mark for that really encouraging word, particularly on the livestock side, with those keeping those feed costs low for us, because that's certainly been part of why calf prices have jumped as high as they have so far. So, I at least found it encouraging, but I'm the livestock guy, so it's okay. Hey, what I titled this one is just prices are picking up, and we're really starting to see that in the fed cattle market. over the last couple of weeks, we're about 190 if we look at a 5 market weighted average. By the end of last week, we actually had fed cattle sell, particularly in the northern plains, 194, 195. Which is really a pretty sharp increase during the week last week. So we continue to see these prices moving higher, which that is spilling over into the calf market as well. We're continuing to support those with this higher fed cattle market. I think I want to get to some of the things on beef production and some things like that, but I think one of the remarkable things is we continue to move these prices higher as we're producing more beef than we produced last year. So, one of the things I think we're continuing to see is some pretty good beef demand. Consumers continue to buy beef, even at what are very high historically retail prices. And so, that's pretty positive that even in the face of these kinds of prices, folks are still buying, and it's showing up in the fed cattle market. Again, this is a 5 market weighted average price. One of the things I think you'll see talked about in sort of the popular press in the next few days and weeks is a very wide spread between northern plains cattle and Texas cattle in fed cattle prices. And I think I think we ought to look at that as a lot of function of available supplies and some of that. But we do see some pretty wide spread between those prices, and that doesn't always happen. But I think that's something we'll see talked about as well in coming days and weeks. One of the other things is when we talk about prices picking up, we're seeing that in the fed cattle market. We're finally seeing that in the cutout or the wholesale value of beef, where that's moved up to, I think we averaged $319 last week. And that's up, fairly dramatically over the last 6 weeks to 2 months. We're up, almost, at least certainly over the last 2 months, about $20 a hundredweight. So that's really some movement, maybe a little bit delayed, quite honestly, as we get, we're past Memorial Day already. We look for that as some of our grilling season stuff, but we're probably a little delayed, but we're seeing these prices continue to move a little higher. So I think that's also positive in terms of the overall level of prices, that we're moving these wholesale prices up. Fed cattle prices are increasing, and that's spilling over into our calf market as well. So I think that's pretty positive on the cattle side in terms of prices. I wanted to get to production a little bit, and this is weekly beef production. So it's fed cattle and it's cull cows and cull bulls. And as we look at this, it's particularly apparent over the last 2 months, where we've had beef production larger than a year ago. And so I think that, that surprises some people. How can we be producing more beef? Well, remember, we've put more cattle on feed. We've pulled animals to place them earlier. We're feeding them for longer periods of time. And in fact, if we look for the whole year, beef production this year is actually about even with a year ago. It's actually just a touch more. And the increase is really on the fed beef side, because we're producing less cow beef. We've got sharply fewer cull cows going to market, a lot less of that cull cow beef that in large part goes to ground beef. We've got a lot less of that, but we got a lot more fed beef coming on the market. And so that's how we're sort of even. But if you look at that, really a function of more cattle on feed and heavier weights. I think this is still an ongoing story and a striking one at that in terms of beef production. If we looked at dressed weights, these are the average of steers. Again, we were at 920 pounds last week. We've been about, a little bit better for, back since March. And you look at that difference to a year ago, the difference to a 5-year average, we've got sharply larger dressed weights. You know, if we look, the heifers look the same way. In fact, cull cows' weights are heavier than they were a year ago as well. And so the real contributor to beef production that's equal to a year ago is really coming from the dressed weight side. We've got much, you know, quite a bit heavier cattle, a lot more beef production. That's coming from this dressed weight side. That shows up in a couple of, I think, interesting areas. I want to show you some couple more price ideas. With these really heavy weights, one of the things we see is, gosh, we've got some more cattle grading prime, a choice about where it was a year ago, but the combination of the two is more choice and prime beef. But one of the things we see is the yield of those has, we got a lot more yield grade 4s and 5s. So one of the things that's showing up in the markets, we think about ground beef and hamburger grilling season over the summer. If we look at these wholesale beef, this is boneless beef, 50% lean. Take a look at prices so far this year, dramatically lower than last year, even lower than a 5-year average, less than $1 a pound. Really gets you to this this boneless beef, 50% lean. Again, if we think about worse yield grades, we got a lot more of this 50% lean going on, and a lot more supplies of that driving those prices down. Yet if we look at the 90% lean, again, more cull cow beef, more lean beef, we've got dramatically higher prices there. Gosh, we're pushing $3.60 a pound for this 90% lean. So we think about combining that 90% lean and a 50% lean, and we're getting the variety of lean to fat ratio ground beef that we see in the marketplace. You know, with fewer cows going to market, this is certainly supporting the price of our cull cow market, simply because we got less of them and less production. But we really see this wide divergence between 90% lean and 50% lean, which I think it's a pretty interesting dynamic in the marketplace, but really reflects these relative supplies of the type of beef we have. So I think that's something also that's interesting going on in the cattle market as well, is this real divergence between the relative lean amounts of beef and the prices that we have. So on Friday, we got a cattle on feed report that's going to come out. So I'll share with you my pre-report estimates, and I'm just going to use a chart of cattle on feed. You might remember last month, we finally dropped below a year ago in terms of the total numbers of cattle on feed. When this report comes out, I expect to see the same trend continuing. I've got placements down 5%, but I think in the analysts that do pre-report estimates, I'm on the low end of placements. I'm down 5%. I guess we'll see. I think I might be down a little too much on that, but I've got placements that are down 5%. I've got marketings that are just less than 0.5% bigger than a year ago. So in May, with the same number of work days, we moved plenty of cattle through packing plants, about the same number as we did a year ago. So that combination of marketings, even with a year ago, and placements down, gets me to a cattle on feed number that's down about 1.7% from a year ago. So again, we're moving in this direction of fewer cattle on feed, which really gets us to, we think about what's driven our larger beef production from a year ago. Certainly the supplies of cattle are there. The heavy weights have been there, but we're really starting, I think, to turn the corner of fewer cattle on feed to translate to less beef production, at least fewer and fewer cattle being moving to market later in the year because of tighter supply. So I'd watch for that in the cattle on feed report that's going to come out Friday afternoon. I thought I'd pull something a little different and show you the number of table egg laying chickens in the U.S. My vertical axis is is thousands. So 335 million is the top end, 285 million head is the bottom end of that axis. This is how many egg laying chickens we got. And the reason I wanted to mention this is because if we take a look at this, that we continue to have incidences of high path avian influenza continuing to hit our egg layers and turkey flocks. For the latest month available, we were at 305 million egg laying chickens. I just went back to 2021 because I wanted to highlight this 21 to 22 drop, which was the big 2022 avian influenza outbreak. This outbreak that really started last year is still with us, and it's really cutting into our egg laying numbers. If we looked at prices, just in the, we've seen prices actually come down, but now we're starting to see the wholesale market begin to pick up in those egg prices. And I think that's really, we're starting to see as we've cut numbers this far, even with a little better productivity, I think we're starting to see a little bit of effect in the wholesale market of just fewer egg layers, which implies fewer eggs. Even with, I think one of the other success stories is that we've managed to see some increase in productivity where we've got a total flock of egg layers that's producing more eggs, but sooner or later these numbers are starting to catch up to us. So, as you might get some questions or see some stuff about what's going on with avian influenza on our eggs and turkeys, egg layers are really starting to decline because of that. If we looked at the turkey side too, I didn't make a chart of it, but we do see, I think, an effect on the number of turkeys, the number of turkeys that are out there being grown. I think we'll see some more talk about that as we get more in the fall, more towards Thanksgiving. But we've also had some pretty disastrously low turkey prices as well. So we've got this combination of avian influenza dragging down production, yet also that market signal to producers to probably produce less, even with cheaper feed. These are some pretty low turkey prices. So I think both of those are in that mix. So that might be something that's of interest to you as well. And I'll close with just a little chart on lamb prices. These are 60 to 90 pound slaughter lambs. The blue line is this year. We've continued to hold prices above a year ago and even a little better than this 5-year average. I'd point out a couple of things I find pretty interesting in the lamb market. One is that just that extreme volatility of week to week prices that we see. But also, we're seeing our kind of our seasonal decline in prices. We head towards summer, late summer, before that fall pickup in prices. We're on that same kind of seasonal pattern, albeit at a higher level. And so I think that gives us a little look at the lamb market as well, particularly for those lightweight slaughtered lambs. And Pancho, that's going to be my last slide. Let me end the show and try to stop sharing.
David, thank you very much.
And
Great
yeah, any
presentation.
questions would be welcome.
Mark, John, David, thank you very much. Those were great presentations. We really appreciate. Hey, if you all have any questions for David, for Mark, or for John, please let